This setup is not found by making trading hard, but it's from making it lazy simple. We only need to know the trend direction, the swing points, and the planning of the setup. Now we need to know if we should be looking for buy setups or if we should be looking for sell setups. In order to know that, we must know the trend. And to know the trend, we need to quickly analyze the direction of the price action. This will make the swing points more simple to notice. For example, on this market, we notice how every single low was higher than the last low. This is what we call as having higher low swing points. And also, every single high was higher than the last high. This is what we call as having higher high swing points. I'm sure you know that these are swing points of an uptrend, but from the highest level of this market, the price pulled down and ended on a low that was higher than the last low. So far, this is completely expected. But the problem is that from this low, the price went up for a bit, but then it failed to continue to push higher above the last high, but instead it ended lower than the last high. And from this new high, the price fell down, and this fall down breaks below the last low. So if we check again the recent swing points, we notice that the highs are starting to end lower than the previous highs. And also the lows are as well starting to end lower than the previous lows. And that's why when the market was following an uptrend, with expected higher low swing points, but then the last low breaks down, that break is a huge sign of the trend reversing into a downtrend. So before we had a price action that looked like this, basically an uptrend. On an uptrend, we identify demand or support levels on the previous low because the next downside pullback will often pull back into a demand or support before taking the market higher to continue the uptrend, and it's on these demand levels where we can position buy setups. But when the market breaks below the last low, this forming a lower low swing point, that's when the market has a very high chance of reversing into a downtrend, and that's the moment where we stop looking for demand or support levels. And that also means that we stop looking for buying positions because on a downtrend, the market should no longer break above the last high, but instead it should end on a lower high, basically ending below the last high, before eventually pushing down and breaking the last low. And what we care about on a downtrend, since we no longer look for demand levels because buying doesn't make sense, now we start looking for supply or resistance levels, and they are taken from the previous highs. Because the next high has a good chance of ending below the last high, and that's where we look for a selling position. And now let's translate this into the actual market. So we initially had the uptrend that we've been talking about since the beginning, but now because of this downside break that caused a trend change, the trend the market is following is no longer an uptrend, but it just entered into a downtrend. And on a downtrend, we look for supply and resistance levels, because that's where we look for selling positions. And as I said, these supply levels are found on the last highs. For example, let's look at this high. The supply is the last upside candle before the price pushed down, and that level is the entire candle, with the wicks as well. And notice how the next upside pullback ended exactly inside of this supply level that was taken from the last high. It hit the supply and then pushed down away from it, which is what caused the break of the previous low. On a downtrend, we pretty much expect a similar thing to happen. That means that we should look for a pullback to the upside, and this pullback should end below the last high, basically ending as a lower high swing point, and the pullback will often end on a supply taken from the last high. So look at the last high, and the supply is the last upside candle before the market started pushing down. And this is our most recent supply level. It's from this level where we can position a sell setup. More exactly, with the entry on the bottom of the level, with the stop loss above the last high. And for the take profit, I would target most of the times a 1-to-2 ratio when scalping. Because keep in mind that on scalping setups you want to quickly get in and quickly get out. And structurally, we're in a favorable position if that take profit target is sitting below the last low. Because on a downtrend, we're likely to see lower low swing points. And if that's the case, that will bring the price down with better chances of the market hitting the take profit target. Which is what it actually did. Since after that first lower low that caused the trend change, the price pulled up and ended on the supply, now we see that it almost got into the stop loss. You're going to find these situations many times when scalping. That's another reason why scalping is more difficult. It plays with your emotions and makes you break your plan. But those who are able to resist, they will find themselves many times where they thought they will end up losing. But actually, if they just had patience, they'd see that their setup would have ended as a winning setup. Let's try another one, still on the 5 minutes time frame, and we analyze the direction of the price action. We mostly care about the swing points, and in this market, we start from an upside impulse. Then the price pulls back, and after the pullback has ended, the price started again going up with an impulse to the upside, and this impulse breaks above the last high. So far, we're having a higher low swing point that was then followed with a higher high, which was the movement that caused the break above the last high. And the reason we care about knowing that we've had a break above the last high is because it shows us the trend the market has been following. And the trend where the price breaks up the previous high, that trend is an uptrend. And on an uptrend, we look to follow the market that's going up, and we follow with buy positions. And these buying opportunities are found on the last low, because that's where we'll likely find a demand level. The demand is the last downside candle before the price started going up, and we notice that the next pullback has entered right into the demand level, and it's there where the price started to bounce up into continuing the uptrend. The uptrend is continued because the price did break above the last high, meaning that we've got another higher high swing point, and that means that buying positions are placed on demand levels. We'll get there soon, but for now, we need to finish the price action analysis. So we see that from the recent high, the price starts to fall back down. Then it's trying to push up so it can continue to break the last high, but in this case that failed to happen. And what actually happened is that the push to the upside ended below the previous high, and then was followed with the price falling down, and this last downside action has broken below the previous low. So let's pay close attention to the swing points the market has been forming, because we have seen how initially we had higher high swing points that were coupled with higher low swing points. But if we look at the last ones, we're starting to have a lower high swing point that were then followed with a lower low swing point. So this break of the previous low has shifted the previous trend, which was an uptrend, into a likely upcoming downtrend. Because that's what happens during downtrends. Basically, the market is creating constant lower highs that are followed with lower lows. And assuming we've entered into a downtrend, after a lower low, we want to see a lower high. And as you've seen on the last example, the lower high should end on a supply taken from the last high. And that supply is the last upside candle before the price started pushing down. And it's from this supply where we plan a sell position, with the stop loss above the last high, and take profit on a 1 to 2 risk reward. That's enough for scalping positions since they can be more risky. And we noticed that from the last low, the market started pulling back up, and that pullback eventually entering into the supply level, that opening the sell setup, and this time, this happened fast. Right after hitting the supply, the market quickly rejected down, which of course has respected the downtrend pattern of forming a lower high that was then followed with a lower low. This time we're on the NASDAQ, and by analyzing the direction of the price action, we noticed that initially the price action was following a downtrend. We know that from the swing points, because it's on a downtrend where we see the next highs ending lower than the last ones. And it's on a downtrend where we also have the next lows ending lower than the last ones, so essentially having a lower high with lower low pattern that keeps repeating. But eventually the pattern will break, and that's visible on the chart. It's seen when the last high gets broken up with a candle closing above it. For example, if we look at this high, the price is broken up here, but it has done so with a wick, so that's not a valid break. But the valid break happened right here, when the price breaks above the last high with a full candle above the last high. And that's the trend change from the previous trend, which was a downtrend, into a likely upcoming uptrend. Now, as I said on the last example, on an uptrend, we identified demand levels that are found on the last low before the price started an upside impulse, with that impulse causing the break above the last high. That upside impulse is this one, and so we look at the last downside candle before that impulse, which is this candle, and that's our support or demand level. It's from this level where we look for the next pullback to end, before hopefully pushing up into uptrend continuation. So we are basically just looking for the price to create a similar swing point as it recently did, and those swing points are constant higher low swing points, with constant higher high swing points. And it's from the higher low where we look to plan a buy position. That setup, to be more specific, is placed on the top of the demand level, with the stop loss below the last low, and take profit at around 1 to 2 risk-reward ratio, which in this case, it's also above the last high, which follows the structure of the uptrend, because on an uptrend we will likely see a higher high swing point, and if that happens, we get out on the take profit. Now, if you found any step difficult, feel free to watch more of my content because we have a lot of videos covering each of these 3 important steps, and you also have our program linked in the description, where our focus is not only winning, but most importantly, not losing the wins back.